Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund in association with Value Research. Today we'll be talking about systematic investment plans, SIPs as they are popularly known. They're really gaining momentum amongst the investors. 5,500 crore worth of investment is done every month. Are they good for you? Is there unfounded trust in SIPs? Or they're really good? We'll discuss all this in today's Investors Hangout. With me is the CEO of Value Research, Dhirendra Kumar. And my name is Rajesh Lake. Welcome, Dhirendra.
Thank you.
So, systematic investment plan, SIPs. The investors are adopting the SIP way these days. What do you think about it? Do you recommend it? Not recommend it? What is it?
Oh, you know, it's not a matter of recommendation. We have, at Value Research, we have been the oldest, believers in SIP. We have been recommending investors that this should be the default way of investing in any market-linked investment. And the reason why they actually fit in everybody's framework is that you earn every month. We
Right.
work on a monthly cycle.
Correct.
We pay our bills every month. We pay our EMIs every month. And so we should invest every month. Maybe we should invest ahead of spending. So it fits in with our spending pattern or our earning cycle for most of us. Then comes, most Indians historically have been fixed income investors. They are used to, being assured of a return, however low, or even if it is decent but low, people are comfortable. So for them, experiencing something which goes down in value, however good it be, but if it goes down in value even temporarily, investors are very, savers are very difficult, find it very difficult to reconcile with that decline. You have invested, investing for the long run.
Right.
In the interim, your 15,000 rupees accumulated over 6 months period, even if you are doing 2,500 rupees SIP. If you realize that the 15,000 rupee as of now is 14,800 rupee, you will be extremely upset. But if you invest at one go, if you have 15,000 rupee and if it happens in few days time, you are even more upset. So averaging your investment, I think it's the only way, for investors to reduce the risk of investment. There are three things which is important, which is crucial, and it should be followed at all times, which is you are investing your long-term money in markets, you are investing through SIP, and you are investing in a vehicle which is diversified. Because if you if you invest in few stocks and even if you do it monthly, it won't work. So that diversification, averaging your investments, and making sure that you are investing your money which you are unlikely to need for 5 years and more. These three things. So SIP should be the default way for investors to get started. Otherwise, however good you may be at investing, managing your own psychology will be extremely difficult, and so everybody should do it.
Okay. This investor psychology that you just mentioned, you get anchored to a market level. Would you like to elaborate a bit more on that?
Yes, investor psychology, investors think in a herd mentality, and it is not, and it is not easy to change that. Investors get excited about investments when investments have done well in recent past. If you see your neighbors or your friends making money, then you get excited about it. When the market is depressed, when the market has gone down in value, when you come across all the horror news that he lost money, that is the time when you are scared, and that is perhaps a good time to invest. But it's very hard for an investor to really work in a think in that counterintuitive way. So the only way to deal with it is, and so you can't perfectly time the market. You don't know how that depressed period of that market will be. You also don't know how the exciting phase of the market will be. So the only way around it is follow a methodical investment plan. You will be able to average it. You will not be perfect, but and then for SIP investors, actually a market downturn turns out to be a little exciting. You feel happy that market has gone down and you will be buying cheap. Otherwise, if you were a lump sum investor and if you see the market going down, because to make money in the market, it's important not to be perfect with your timing. Of course, if you can do it, fine. But I haven't come across any fund manager doing it perfectly, so I don't expect an individual investor to be doing it. But so the way to be there, and most of the money is made in the market by remaining invested, because big moves in the market comes with a surprise. You know, when you least expect it, markets move. When you have given up on the market goes up sharply. When you think that the market cannot go down, then it corrects, then it goes down substantially. So to benefit from that, SIP is the only way. And psychology is very much against us, because the decline in value which you see in a brief period shakes you up, and it drives you out of the market, and you are deprived of this market, this great thing which, a market linked investment, equity markets in general, in a methodical way you can benefit from. You are deprived of that.
Okay, moving on. You just mentioned that when you invest through SIPs, there's a probability that you will not lose money.
Yes, what happens is
I
that,
mean, my antennas got up.
yes, it has actually turned out to be, a lot of people think that if you do SIP, then positive returns is your birthright.
Guaranteed.
And guaranteed, because you have done everything right. You are investing in market.
True.
You are averaging it. You are investing in a diversified vehicle. So how can you lose money? You can still lose money in the interim. I'm still hopeful that if you do your SIP on any 5-year basis, 6-year basis, you are unlikely to lose money. Not only you are unlikely to lose money, you are likely to make more return, generate more return than fixed income, because that is something which is, your risk-free return. You do nothing, you don't look for any fund, just go to your friendly neighborhood post office or a bank and start your recurring deposit. So
Correct.
that is the return which everybody should expect. But if you are aspiring for a higher return, and you are willing to withstand these ups and downs, then you are taking some risk, and this risk gets reduced only with time. So if you start investing today, and next 6 months market goes down steadily, you will lose money. You lose money on SIP on another count. Think of, we always keep encouraging people that even if you have lump sum money, if you have 3 lakh rupees, don't invest at one go. Average it over the next 12 months at least. And that averaging, you should follow a principle, how important that money is, and what is that money excuse me, that money, what is the what percentage it is of your total net worth, because depending on that importance of that money, you behave differently. So on these two count, I think that investors behave in a fairly erratic way, and so you have to average it. You have to, but investors have started believing that if you do SIP, you are done, you are taken care of, nothing can go wrong. No, it can go wrong in the interim.
So that was my question then. If it is so good, then why shouldn't we carry on with this? Is there a problem associated with SIPs?
Yes, there is a problem associated with the SIP, and the way the myth is actually gaining popularity, that if you do SIP, you can't lose money. So if an investor in the interim sees that his investment value is lower than his worth of investment, excuse me, the cost of investment, then it's a problem. He'll be disappointed.
So SIPs have 3 major advantages. Suitability, that means you earn monthly, you save monthly, so you invest monthly. The other thing is about rupee cost averaging. And the third thing, which we delved deeper, was about investor psychology. You don't get anchored to a market level. And these are the 3 reasons why you should need to do SIP.
One point which I was, not able to elaborate on is one point which I would like to elaborate is that investors, we always encourage investors to invest even their lump sum money over a period of time, average their investment. And in that case, there is a loss, because if market is steadily going up, you could have bought cheaper, but the market went up. But mind you, this is an opportunity loss. Many a times investors complain that they should have invested lump sum. So SIP is nothing but a great tool to actually form a habit, manage your psychology,
correct,
align it with your income cycle, and these investments, I think these investment habit is for a lifetime, and 1 year, 2 year, or 3 year of underperformance, or 2008 happening in the interim, or few weeks, few months being disappointed about this investment is not the issue. The issue is that you develop a plan, it works for you, and then if you are able to stick to it for a lifetime, then it turns out to be extremely rewarding. And it is that kind of belief because of which investors can benefit from the markets. So you have to form a belief in the method that you are following and stick to it.
So therefore, what I deduce out of this is the problem is not with SIPs,
Yeah.
it is with the expectation from SIPs.
Absolutely.
Okay, so if I'm an investor, what should I be doing? If I'm a SIP investor, what should I take care of? You did mention that long term is important, be regular in your investment. What else?
Do nothing. In fact, doing nothing actually works in most cases. Of course, what you should be doing is that most of the time we'll think of SIP as a constant money, that we are investing 5,000 rupee a month. All the calculators, all the online tools, they talk about 5,000 rupees a month if invested for last 15 years or next 15 years at this much percentage, how much it will translate into. That is not real life. Real life is that sometimes you lose your job, and most of the time you get increment, your income grows, and in that sense revise your SIP amount. Be methodical about it. You have absolutely no control on the state of the market, but you have a full control on what you do with your money, what you do with and how you behave, how you conduct. So you start with 5,000 rupee. Make sure that if your income goes up by 10%, you are able to increase your investment by 10%. And if you keep doing it, doing it for 5 years, I think you will see the results yourself.
Okay.
You will not have to listen to investors hangout to get a reinforcement in this idea.
Okay, so we talked about the myth also here that you cannot lose money in equities if you invest through SIPs. So that, according to Dhiren, is a major myth. And so continue to invest and do nothing, as you
Yes.
very
If
rightly
you are
said.
onto a SIP plan, make sure that you are revising your SIP amount every year, and you are doing it for at least 5 years before you do a review. And then I don't think you will need to do a review at all. I think the real returns or the realizability of that investment, and take a note of all the time in the interim when you would have got anxious, you would have thought that maybe you have not done the right thing, and take note of that, and any 5 year time period you will be pleasantly surprised, and it will prove to be hugely rewarding.
Didn't I, for one, when once I have invested, I forget. I take his mantra very seriously. I completely forget that it's gone.
Yeah.
It's taken care of. Everything is gone. But are there any situations where we need to panic when it comes to SIP? Are there any market trends that we need to be watchful of so that
Yes, I think two cases, two situations when you should be watchful, but they are not actually market dependent. One is that you have chosen a fund, and that fund, when you started investing, it was a good fund, and over a period of time, 1 or 2 years, you find that it is not proving to be a good fund. You should review your position. The other situation is actually internal, that will vary for an investor to investor, that if your circumstances change, you thought of long term investing, you thought of investing for a long period, but then something happened which actually makes you think that you will be needing this money in a year's time, you will be needing this money for an emergency,
right.
and it is your money. So when you have such situations, anything which actually prompts you to reconsider your long term orientation, or the investment has turned not so great as it was expected, in these two situations you have to reconsider. Otherwise, I don't think. And that first situation, that the fund is not proving to be good, that will arise after 2, 3 years, because I don't think mutual fund should be evaluated on a brief time period.
You mentioned an unforeseen circumstance like one losing a job,
Yep.
for example. So, in that case, you need to bring down your SIP because you don't have the money to give.
Yes, there is also, a lot of times people think that, if you have actually given a SIP instruction, uh, then being a defaulter, you have given a authorization that a bank mandate that debit my account. All you have to do is cancel it if you are unable to make that investment, and it is not a it's not a violation of a contract. When you borrow money and your check bounces for your EMI payment, it's a problem. You have borrowed money. This is where you have chosen to invest. This is not a violation, but plan it. When you have to cancel your future SIPs, do it methodically. It can be done by informing the fund company and canceling the bad mandate if you have given if you have done it online.
Okay. So you heard about the advantages of being systematically invested in your various funds, etc. So make sure that you continue to do your SIPs diligently and as regularly as possible, unless, as Dhiren mentioned, something unforeseen happens. You're listening, and you are with us on Investors Hangout, and now we'll be taking questions related to SIPs, if possible, and the questions that you have sent us. Dr. Agarwal says that while continuing with SIP, is it okay to step up contribution for a limited period only?
No, don't do all that. The whole idea is that you should be systematic, and this is not being systematic. It is trying to predict the timeliness, or if at all you have some extra money that has come your way, just spread it over a period of time and choose the time period. We have talked about it in earlier sessions. How long should be if you have you got your annual bonus, maybe spread it over the next 6 months. If you got a very sizable derivation money realized by selling some asset, which is a big sum, then maybe spread it over the next 3 years. Be methodical, be systematic about because the whole idea of this SIP and being methodical about it is to fit in with your cycle, with your own financial net worth, how your money is managed, and and that is the only way you will be actually keeping anxiety away. Because the moment you do these things, which is invest larger amount or more for a brief period, you are expecting that the market is relatively cheap or relatively expensive. I'll
Timing
tell
the
you,
market as
timing the market, it has not worked. Look at last 1.5 years. I have come across many investors who keep writing to us. They have been waiting for the correction. They have been waiting for the decline in value or a market fall to invest again, and they have done all the waiting while the market has gone up by 30%. If you are investing for I keep coming back to the whole thing again. If your investment time frame is in place, if you are investing for the long run, and if you are methodical about it, most of the return that can be derived from the market will be you will be able to access that. If you try and do all this, sometimes if you succeed, you will start developing a false belief which will take you in the wrong direction. If you fail, then of course it is disappointing.
So, Dr. Agarwal, no contributions.
We remain systematic.
Systematic is the buzzword.
Yep.
Systematic. Okay, Bhavish Patel has written us, as per your suggestion, Dhirendra, I started an SIP of rupees 8,000 in a balanced fund. My age is 40 years and my time horizon for SIP is 10 years. Please suggest if my investment is safe or not.
10-year SIP, worried about safety, then I think you have done an excellent job. I would have thought that somebody investing for 10 years who is 40-year-old should start with a multi-cap fund. But I'm confident that on any 10-year basis, and also the kind of market we are in, and your concern for safety, which looks paramount, you are on to a great plan. There are 2-3 kind of when it comes to safety, there are 2-3 things which comes to my mind. How safe is mutual fund? So you derive the safety from the design of it, and we haven't come across any fraud or any misstep by a mutual fund company so far. When it comes to market, safety in the market, no, markets are none of the mutual funds offer you guarantee of capital or guarantee of return. It's not like a bank deposit that you will earn 7%, no more, no less. It is none of those. You don't. So be aware of this, and you will be deriving the safety by choosing a balanced fund and by choosing a way to invest which is SIP. 10-year time frame, investing in a balanced fund which is 70% equity, 30% debt, and it will actually not crumble if the market falls dramatically. You are and averaging your investment over a 10-year period makes me think that you will beat the fixed income return by a handsome margin. It will translate into something sizable over a
Right.
10-year period. I would like, but you can actually look at the kind of accumulation that would have happened over the last 10 years with all the
Yeah.
balanced fund. It will be something very significant, and I would only urge you to increase your investment amount every year as your income rises, and then it will become even more interesting. In fact, it will it will look like a small amount, but it will translate into something far bigger. In fact, twice as much if you grow your savings, grow your investment, if you increase your investment by 10%.
That's very heartening to hear. Okay, Usha writes in and she says that is it okay to do SIP in sectoral funds for 2 to 3 years?
The reason why you invest in a mutual fund is to diversify, and sectoral funds are opposite of that. They focus. They invest in one sector only. And you have 3, 4, 5 sector funds, kind of sector funds available: banking, pharma, IT, and some some very special, some unique funds, transportation and logistics, or some such thing. I would say that diversify. Uh, if and You should invest in a sectoral fund only if you find that there is a sector which is missing in your portfolio, which is not reasonably in your portfolio, and you for some special reason you are personally convinced that it is a promising sector. If that is not the case, invest. Diversification, regular investment. I think these two things are critical to follow.
Next question, Swapan Kumar Datta. Should I withdraw from PPF and invest in equity mutual funds, or should I go into via the SIP route?
Uh, I would strongly urge that, and every time I tell people that you should discontinue your PPF and start doing your uh, SIP, and it'll prove to be hugely more rewarding. A lot of people get angry, and understandably so, because people look at it from a different standpoint. They think that PPF is something which we were told by our grandfathers and father, that's the only way. And maybe those times were different. Market was not accessible. SIP was not possible. Investing in mutual fund regularly, 5,000 rupees a month, was not possible 10 years ago, 15 years ago. Market was a dangerous place. Brokers were used to operate, and it was a closed club. Accessing the capital market, investing in shares, was entirely a matter of investing in IPOs. So those times were different. Today it is accessible. You are able to access the market in a very convenient manner.
Right.
The banking and other technological advances are enabling it even more smoothly. And look at the returns. I would just like to, even if you invest in a not so great fund, uh, a poor fund, and do it over 15 years, because we have to really understand that your PPF is a 15-year recurring deposit with the government, and it will earn you a fixed income, 8.3% right now, and it will be on a decline if inflation comes down. Now you are not getting that guaranteed 15-year term. Now the return on PPF is also getting revised. Of course, the advantage of PPF is absolute safety. So if you're a very risk averse person, you don't want to take any chance with your money over any time period, maybe don't think of anything else. But otherwise, taking small chance and trying to increase your rewards substantially, your returns substantially, I think everybody should discontinue their PPF and do their SIP, because PPF is a 15-year recurring deposit. And if you are that methodical, that meticulous about your investments, without any feeling, not only that, a lot of people say that all my return from PPF is tax free. So is your equity fund. If you invest in a balanced fund or equity fund and hold it for 1 year, all the return is completely tax free. So that is the situation as of now. So on tax efficiency, in terms of return potential, and in terms of safety, where PPF is absolutely guaranteed, it can't go wrong ever. But this is because it's backed by Government of India. But SIP 15-year period, if you are optimistic about India, or India will actually, if not improve dramatically, if it will be a little better place in 15 years time. And if you look at any past 15 years, I think things have improved. We are a better economy, we have better businesses, we are more compliant businesses, we are more efficient, more transparent businesses. So, and you are basically betting on, it's a general bet on Indian economy. If you think that India will be a better place and better businesses in future, then PPF, doing your SIP in an equity or a balanced fund will translate into something substantial as compared to something very modest in PPF.
Through PPF. Okay. Very interesting. Okay, we have a question from Rahul Gaurav, and he says, I'm thinking on investing, putting aside 3,000 to 5,000 per month to invest in mutual funds for the education of my 3 children. Please guide me. Where should I invest or continue to be in the SIP?
Invest. 3 to 5,000 rupee for investing for your child's education. It's entirely a function of how much time you have. And of course, it is a non-negotiable goal. But for a few children, 3 children, you will be needing the money at different time. And I hope that you need the money only at the time of graduation, or they get into graduation. After school, they get into college. That is when you need it. So it depends on the time frame. If these milestones are coming your way in next 5 years for the first child, maybe, then you have to really deal with it conservatively. Maybe start with a balanced fund. If all these goals, they are likely to get into the college 10 years from now, then be with a multi-cap fund. Invest as much as you can in a multi-cap fund and carry on. And one important thing to note will be that as you get closer to the goal, when your child is likely to get into the college, do your estimate of how much money you are likely to need in the first year. Take that much amount methodically in the last year. Maybe average your withdrawal in the last year before you need the money. Don't wait for the last moment. Don't wait for the child to get into the college. Don't be dependent on that market, because you are averaging your investment. It is as important to average your disinvestment as well, to get nasty surprise from the market.
Okay. We actually did discuss some time back about how
to go about withdrawing it.
Withdrawing. So look at those programs if you can, and you will get the answer to what Dhiren is saying. Okay, moving on. Sandeep Tyagi says, I'm a new investor and I have heard that through SIPs we can get a much better return compared to banks and post office deposits. Please advise on this. I'm 40 years old, earning 60,000 rupees per month, and I want to build a corpus of rupees 1 crore in 20 years.
Yes, and in fact, across the board with mutual funds, you can actually earn little more than whatever is the other fixed income alternative, because your money is lying in a savings bank account. That money can move into a liquid fund and it can earn little more, maybe 50% more. If you earn 4% on a savings bank account, maybe you can earn 6.5-7% from a liquid fund. That is money for few days, or money on call. Money for few years, substantially more than PPF, because that I think comes to my mind when it comes to a long-term investment. And save as much as you can. Get started with SIP with confidence. Do your SIP in a balanced fund for first 1 or 2 years, because markets are very volatile. It takes time for investors to get used to it. And save as much as you can. Do only SIP. Make sure that you are investing this money which you are unlikely to need for 5 years, 10 years. Don't review it every day. Don't look at the value every day or every week. And do it for 1 or 2 years in a balanced fund, and then gradually move on to the multi-cap funds.
Okay, I'm afraid that's all we have in today's Investors Hangout. But just want to point out one thing to you, that the industry is adding 8.8 lakh new SIP accounts every month. So if others can see that this is good, then you too must see that this is very, very beneficial to remain systematically invested in your investments.
Sure.
Thank you very much. We'll see you soon on Investors Hangout.